It looks as though the world is at war. What does that mean for you and your portfolio? Are you changing your investment decisions as a result of what's going on? We're speaking to an industry veteran today who's going to be helping us to think about how we can make better wealth decisions in the context of the world today. This is Make Better Wealth Decisions, a podcast dedicated to helping pre-retirees and retirees manage risk and economic uncertainty by adopting a pension-style approach to improve your risk-return trade-off. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. We're speaking with Peter Hodgson. He has been in the investment business for 41 years, and after leading Sprott Asset Management as chairman in 2011, he formed an independent research network, Five Eye Research, and bought Canadian Money Saver magazine, where I've been writing for over a quarter century. His focus now is on helping do-it-yourself investors, and he helps them navigate the complex investment world and prosper for the long term. He has a Bachelor of Economics from Western University and a Chartered Financial Analyst designation. How are you today, Peter?
I'm doing okay. Thanks for having me.
Well, it's a pleasure. As people listening might not know, but I've been actually wanting to have Peter on for a while, and I've been a bit slow in getting him to come, but he's been very gracious in agreeing to appear today. So I'm very thankful for that, Peter. So thanks. I want to begin by asking you very open-endedly what your thoughts are about how people can be investing in 2026 in an environment that's full of geopolitical uncertainty.
Sure. Well, first of all, I'll highlight your 25 years contribution to the magazine because, we're both getting older. And I think the real main point is I've been in the business now about 41 years, and I've never had a single year where everything is good. There's always a crisis to worry about, whether it's economic, whether it's geopolitical, whatever it is. I've never actually seen a situation where everyone's relaxed and calm about investing. So what we're seeing in 2026 is really nothing new. With the advance of technology, of course, everybody knows everything now because they're getting everything on their feeds. And I think what's happened is people worry a lot more because they're seeing a lot more bad news. As you know, media likes bad news because it's more entertaining or more engaging, I guess. And this time around, there's lots to worry about, but there's really not more to worry about. You're just more aware of what's going on. In the olden days, of course, pre-internet, you might not even know what's happening in a lot of the world on a second by second basis. You might read about it in the newspaper, but by then you've had some time to think about it. You've had some thoughts, and you may not panic as much as you might right now when you get a live social media tweet from the president directly and you react to that. So I think the main focus is to perhaps stay calm and look for the long term. If you're an investor for a year or 6 months, then maybe you shouldn't be in the stock market and maybe you should just be in GICs. But if you've got a 3 to 5 year, 10-year time horizon, what we're seeing this year is really not that unusual. You're seeing volatility, you're seeing concern about interest rates, you're seeing concern about earnings, you're seeing concern about inflation. None of that is new. That's just a regular day in the stock market. And I think people have to stay focused, stay balanced, and stay calm. And I think it'll work out in the long term. You might have a bad year here and there, but over 40 years, 15 years, 20 years, you'll be okay.
When you talk about how things are recurring and how things have been, this is nothing new. This is something we've seen many times before. I am reminded of comments made by Robert Shiller, who's written a number of books and won a Nobel Prize. And he talked about how people talked about new paradigms and how automation and robots were going to take away jobs. And there was a big scare about this literally 80 years ago, around the time of the Second World War as industrialization became more commonplace. Well, today, there's a very similar story being told about AI. And, will AI replace you and your job? Will you be out of work? Because it is so topical, I'm wondering if you could weigh in on AI in particular, what it means for investing paradigms and what it means for the economy in general.
Sure. I guess just on the prediction side, I think Elon Musk was saying we're all going to have our household robots by now. And that, of course, hasn't happened. So there is changes going on in the technology world, and there is definitely rapid advancements in certain sectors. But I think what's going to happen is these changes are going to happen a lot more slowly than investors are realize. So for example, we've had a giant AI eats software problem. And if you're a software stock, your stock's gone down perhaps 40 to 50% this year even though your earnings and your revenue growth hasn't actually changed yet. It's all on sentiment about how AI is going to replace software. But when you think about it, if a new AI competitor comes along and you've got highly sensitive customer data and you've been working with your customers for 20 years, these customers are not just going to flip flop over to the next latest AI company to give them all their customer data and all their basically business plans and all their future potential. It's not going to happen overnight. It may happen over a decade, and you may get slower growth and perhaps lower margins as new competition comes in. But it's not going to be day one. A company like Salesforce just goes out of business. But if you look at the stock, that's what investors are thinking. So I think it'll happen more slowly. The robotics side, I think, will happen, on an industrial basis much faster than on a personal basis, and that's already happening right now. Amazon is adding 10,000 robots a month or whatever the number is. And they are laying off staff. And so you will get a displacement of some staff. But I think what's going to happen in the short term, perhaps 5 to 10 years, you'll get employees using AI to be more productive and utilizing new technology and robotics and automation to make more money for their companies. You may get a situation where there's less hiring, and companies might just simply use attrition to reduce their staff. And you may get some industries that are completely displaced at a faster rate. Again, I can't predict what's going to happen in terms of which industries, but some industries will be more impacted by others. But as you pointed out, there's always changes going on, and we adapted to the internet, we adapted to the steam engine and the car, and it will happen, and companies will adapt. And in the short term, it could be very positive for investors because they might see their companies save a lot of money simply by not hiring new people. And as long as that demand stays strong and as long as there's not a giant recession, profit margins could go up quite a lot. And then when you think about it, if a company's making more money, they're more likely to invest. They're more likely to plan for the future, and that can offset some of the job displacement. So I think it's a concern, but I think the concern is too concentrated in the short term.
As I was listening to you speak, I saw a post on social media just this past today from the managing partner of my firm, Design Securities, where he mentioned that there's a bit of a false dichotomy. People are talking about, for instance, in the field of giving financial advice, a lot of people say, well, will AI replace the advisor? And he said, and I thought this was quite insightful. He said, well, actually, it'll be advisors who use AI that will displace the advisors who don't. And the idea is that the future for virtually any industry is, I call it cyborg, where it's not just human stuff, but it's not entirely AI either. It's going to be the two working hopefully symbiotically and giving us an output that is fast and professional and better for everyone.
Yeah, I totally agree. And I do agree that one of the reasons why, we still like the sector in general is I think as you mentioned, every single company in the world is going to have to use some sort of AI software, agentic program, or robotics, because if they don't, they're simply going to get destroyed by their competition. So that spending pattern is going to continue, I think, for far longer than what people think. But it also, again, it's an enhancement, not a replacement. So for example, in our company, 2 years ago, if someone asked me a question about a company, I would look up sort of a description of the company so I'd get it accurate, and I'd type it all out. I mean, now I don't do that because I can do that with AI, but it doesn't change my opinion of that company. It just saves me 5 minutes typing out what the company does to our customers. And it's actually far more accurate because it's being told right from the company's website. So I never get anything wrong. But the reason companies are paying us is for an opinion on that company. And that doesn't change. The robot opinion is not going to matter as much as someone with 40 years experience in the capital markets. So it's exciting, but I think people are they're worrying too much and they're freaking out too much. The one thing that is interesting, and it could cause some sort of angst, is we're due for a recession at some point. And in a recession, people lose their jobs. And I think in the next recession, people will equate the job losses to AI, perhaps prematurely. And so there may be some total psychological damage where people are like, oh my goodness, we're losing hundreds of thousands of jobs due to AI, where it might actually be just due to a regular run-of-the-mill recession. So it'll be interesting to see how that plays out.
I'm wondering if we can move from the cutting edge technology of 2026 to maybe your roots and the things that you used to do when you were at Sprott. Talk to you about gold and precious metals and why they're on a run right now. Because, certainly with your time at Sprott, you would have been very familiar with that asset class and the thesis surrounding it. Why, oh, why are gold and precious metals doing so very well in the past 2 or 3 years?
It's actually been really, I don't want to say fun for me, but it's been really interesting for me because my 7 years at Sprott, I was indoctrined in everything gold and silver and precious metals related. And also at that company, there's quite a few people who kind of believe in the conspiracy theory on gold where, it's being manipulated because there's a shortage and you've got Fort Knox hasn't been audited in 55 years and nobody knows if the gold's actually there, et cetera, et cetera. So it's very interesting for me seeing sort of the transformation of some of those theses into reality. And so certainly in silver, there's a big shortage of physical silver, and the production of silver has been less than the usage of silver for almost 15 years now. And there's also a big theory that there's a giant short position in silver that's based on paper silver and not actual silver. So when silver goes from $50 to $110, as it has over the past year briefly, I was like, oh yeah, that's exactly what was supposed to happen, but we're 10 years or 15 years behind schedule. But really it comes down to the main question is this. If you think that any government is going to be fiscally responsible and spend less money than their revenues over the next 15 years, then you don't want to own any gold and silver. But I have yet to meet a single person who actually thinks that any government's going to be fiscally responsible and spend less money than before. So that's one thing. And you've got this big debasement of all currencies. And we're starting to see, we've seen that across the board. You've also seen the fact that crypto perhaps is not the store of value that people thought it might be. It hasn't held up in a crisis. Gold's actually massively outperformed it now over 5 years. And it's like gold has been a store of value for 5,000 years and crypto's been whatever it is for 15 or 20. And you've also got central banks who are concerned about the US dollar. And we saw this with the Greenland situation. The rumor is that Donald Trump backed off on Greenland because the European Union was basically going to say, we're going to sell all of our US bonds and we're going to destroy your currency. And I don't know whether that's true or not, but the US dollar has been very, very weak, which is very positive for gold and silver. Then you get central bank buying, store of value, debasement of currencies, and the fear factor. Of course, that's kind of always present and perhaps a little bit more so with multiple wars going on. And gold suddenly kind of hit its stride where it's like nothing else was really the safe play over the past 2 years or so. Whereas gold was like, okay, everything is positioned for gold to go up. So let's just go there because I don't know what else is going to be working over the next little while. So I think the rally was perhaps, a little bit overdone, but I'm not too sure it's going to stop anytime soon.
Yeah. So if I'm hearing you correctly, I don't think you're concerned that despite gold having gone up, 60 or 70% a year for the past 2 years, over 120% over the past 2+ years, that it's overvalued right now and that it might still have legs and might continue. I don't want to put words in your mouth, but that's what I think I'm hearing you say in terms of connecting dots.
That's absolutely true. And what I look for in investments is I look for things that are more assured than anything else. And honestly, gold and silver in isolation are kind of like the easiest call. It's like not the sector I worry about. Whereas, I'm worried about software. I'm worried about consumer spending. If there's a recession, I'm worried about the housing market. If real estate collapses, I'm worried about technology if the valuations are too high. And it kind of everything, it's a safe sector for me right now because everything is still moving in its favor.
Okay, so let's go there. You just said you were worried about technology possibly because valuations are high. Earnings have been very high for, let's say, the Mag 7 stocks as an example. And yet here we are in March of 2026 and all 7 of the Mag 7 stocks are down. And all of them are down more than the S&P 500 that they're benchmarked against and part of. I have been worried about valuations literally for years. And there have been people who have said, well, as long as earnings are strong, don't worry too much about valuations. Where do you come down on this interplay between earnings being reasonably strong, but valuations being stratospheric?
Yeah, and I think we have to separate the Mag 7 from sort of the regular companies because we are seeing very, very good valuations in certain companies. And we've got a sort of an average S&P growth rate for 2026 in the 13% range. And yet the valuations change every time a stock ticks down. So I think if we X out some of the outliers like Palantir or things like that, or they're trading at 75 times sales or 100 times sales, I don't want to say I'm really worried. And just you have to be a little bit more selective because these companies will grow into their valuations over time. And we're seeing a lot of small mid-cap companies that are growing 40, 50, 60%. Doesn't take too long at that growth rate to change a valuation significantly. And then if a stock goes down 15% at the same time, then that stock can be actually very, very attractive over time. The other thing is if interest rates do decline, that should help the sector as well. So I think caution is advised, but I wouldn't want to be too underweight the sector either, because that is where the growth is. And that's where the growth is going to be coming from. So if you're careful, you can still do very, very well. So I wouldn't short the sector. I would just have a decent exposure of good companies without crazy valuations. And they're out there.
So I wanted to jump off on something that you had as a preamble to one of your comments just a minute ago, which is if interest rates don't decline. A lot of people have to, as they try to make better wealth decisions, they have to navigate the fact that there's a lot of uncertainty. There's always been uncertainty. Yeah. And it seems as though the stakes are higher, but maybe that's putting words in your mouth because you're saying it has forever been thus. But I know that a lot of people expected rate cuts in 2026. And I know that in the aftermath of the war that started a few weeks ago, that there's now a concern that inflation will be running hot and that it will be difficult for central bankers anywhere to reliably, credibly cut rates. So I'm wondering if you have any thoughts on what we might be expecting. Again, maybe not so much a forecast, but maybe, what do you do if rates are cut? What do you do if rates stay stable? What do you do if rates go up? Given the fact that I think the certitude of what's going to happen with monetary policy is now not what it was, say, back in late February before the US and Israel invaded Iran.
Yeah, I would agree. I mean, almost every economic, I don't want to say crisis, but every economic downturn is usually preceded by an oil crisis if you go back over the past 50 years. So much is going to depend on how long this war lasts. And the other thing that overlays that, as we were talking about, is there will be some deflationary effect from AI. If companies can reduce costs, then that takes a little bit of pressure off the system. But if the Iran war drags on for a year, then all bets are off in terms of rate cuts because the central banks will just be too paranoid about inflation picking back up and kind of shutting everything down. And you don't want a stagflation scenario at all. And we're actually seeing some slowdown right now. And so if you get a slowdown and inflation, it's worst case scenario really for everybody involved, investors included. So you want this war to end sooner rather than later. At the very minimum, you need some displacement of inflationary pressures elsewhere. So whether that combined a recession could possibly do it, it could take some pressure off. So it really has changed in the past couple of months because everyone said, okay, inflation's under control, rates are going down, and corporate earnings are going up. That's almost a Goldilocks scenario. But now oil spiked. We don't know what rates are going to do, and we don't know what inflation is going to do. It's almost the opposite of Goldilocks scenario. So yeah, I would be cautious, but again, not in a panic sort of way. No one has to go to cash, and no one has to, just be ultra conservative, but just be balanced and don't chase things. Watch out for the FOMO trade and just have a diversified portfolio and you should be all right.
I've written about this and I've put out videos about this with the concept being what you're talking about without using the portmanteau, and that is the word stagflation. And, there is a concern that that stagflation may yet be part of our lexicon in 2026. And really, we haven't had to worry about it for over 50 years, since 74, 75, when we had an oil crisis because of OPEC. And yeah, things seem to be lining up where history may not repeat, but it seems to be rhyming. And that's not necessarily a forecast, but it is an awareness of what could happen and what has happened. And if you're trying to make a smart decision about how to proceed, you should at least be aware that that is a viable outcome. certainly not a desirable one, but it certainly might be a world that we live in the foreseeable future. And I think you need to be prepared, as you say, balanced portfolio, broadly diversified, don't go to cash, don't do anything rash, but be mindful that this too is one of the possible outcomes.
Yes.
I wanted to end, Peter, by asking you about Bitcoin, because most of the people that I talk to don't really have an opinion. And I confess that I don't really have a strong opinion about Bitcoin. But I think you're a little more in tune to cryptocurrency, what its role ought to be and what it has been as a portfolio diversifier for the past number of years. Again, an open-ended question. What's your take on Bitcoin in particular, but cryptocurrency in general, in terms of what we should be expecting, given what we've gone through these extreme swings in both directions for the past 7 or 8 years?
Yeah, I mean, just to clear up, I'm not the expert at our shop. We have a guy named Chris Wright who's really, really informed on this topic. So a lot of mine will be echoing what he said. So I think what's going to happen is crypto will end up to be an asset class that's much smaller than what people expect. So it will be an alternative investment that people can buy as a non-correlated asset to other securities. Now, that being said, it hasn't exactly been uncorrelated in the past, but I think it'll end up to be non-correlated. So I don't believe in $1 million Bitcoin, and I don't believe in a $0 Bitcoin. I think it'll have a very niche part of the market. And I don't think people need to have exposure because of the volatility. So it'll sort of continue to be a sort of a niche alternative investment for the cool kids who don't have enough money to drive it to $1 million. But I have heard that the millennials don't think it's cool anymore, and they're moving all their money to the prediction market where they can double their money overnight on some wild random guess. But I really think if it was going to be sort of the next greatest thing, it would have happened already. And the other cryptos, I think we have 24,000 coins now. I mean, it's just ridiculous, really. And I don't think it's going to go the way of the NFTs, but I think you're going to end up with 3 or 4 major cryptos that trade in a niche type of market that's relatively small compared to other assets.
Well, that's good. What I think I'm hearing you say is that it's hip to be square, and that people like me who have avoided crypto throughout their entire careers are perhaps being rewarded for having done so. It's ironic because I'm a big proponent of alternative assets in general, but crypto in particular is something that I've always been reticent to go there with, just because of some of the things that you're talking about, and the fact that there's no real underlying value that supports it. So it strikes me as being something where we could be looking at greater fool theory, where it has value because people say it has value, but not because of anything intrinsic. Peter, you're a lot of fun, and I know we could talk about a lot of things for a long time, but I'm mindful of time. So I always like to finish with the question, and that is, the podcast is called Make Better Wealth Decisions. If it was up to you, Peter, what advice would you give the listeners to help them make better wealth decisions?
Probably just stay calm in volatile markets and do not be greedy is probably rule number 1. At the same time, though, one of our biggest tenets is don't sell too early. If you have a winner, instead of being greedy and say, I'm just going to let it ride, put yourself in the buyer's shoes. Ask yourself, why is this stock at the current level? What do people see? And that can change your perspective a little bit. It's like, okay, I want to sell it, but 1 million people just bought it. So what are they doing? Why do they have a different viewpoint? And I think that's very important to sort of manage your gains, because a lot of people say, I got a double, I'm out of here. And then meanwhile, the stock will go up 10,000% over the next 10 years. And where you really need those big winners to offset the losers, which you will have. They say that 70% of the stocks are going to go down, and over time, you need to have those big winners. And of course, the math is in your favor. So remember what you learned in math school. You can only go down 100%, but you can go up 50,000%. And that's sort of the miracle of investing. So, but it's really the short-term focus and the panic. And you just have to sort of don't listen to everybody, stop looking at your social media feed for your stock quotes.
Thank you very much, Peter. It's been a pleasure, and we will be talking to you down the road. It's been a real pleasure.
Thank you so much. And thanks for your contribution to the magazine as well.
This podcast is not to be construed as offering specific financial advice. Please consult a qualified advisor before acting. Be sure to subscribe if you haven't already.